Hello everybody, my name is Alesh Eisner and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record a video per week, so make sure you ring the notification bell to get notified each time one comes out. This is my stock pick video for the month of September 2024, and this time it is the Bank of Montreal. Bank of Montreal engages in the provision of banking and financial services to individuals and institutions operating in Canada and the US. The company was founded in 1817 and is headquartered in Toronto, Canada. The market cap is around 81 billion. The current price is $112.71 Canadian at the time of recording on September 1st, and I see the current fair value being around 125 to 130 per share. The narrow moat rated Bank of Montreal reported weak third quarter earnings as high credit costs, particularly from the bank's U.S. operations, weighed on results. Revenue increased 1.7% from last year and 2.7% from last quarter to 8.2 billion Canadian. On the other hand, adjusted earnings fell 7.3% to 1.98 billion Canadian, and these results translate to a return on equity of 10%. Credit costs were expected to continue to climb. The bank's credit results were worse than we had anticipated. Provisioning for credit losses increased 29% from last quarter and 84% from last year to 906 million Canadian. Like last quarter, most of the increases came from high allowances on impaired loans, reflecting a continued deterioration in credit performance. Gross impaired loans increased to 0.89% of total loans from 0.79% last quarter and 0.44% last quarter. So the loan provisions are going up for impaired loans. The next impaired loan formation decreased modestly from last quarter but remains higher than normal levels. I see the loan loss provisions as being prudent, making the bank well capitalized where money is set aside when there is a risk of loans having to be written off, but nothing has happened yet. And with Canadians wanting to keep their houses, they're not going to default on their loans. And it's very likely these provisions will be put back into earnings in a future quarter, making that future quarter spectacular thanks to the bad quarter now. They actually have had a couple of bad quarters, to be fair, by missing some consensus expectations. Interestingly, a disproportionate amount of credit quality weakness is coming from the bank's U.S. operations, despite some initial concerns around the Canadian mortgage market and higher Canadian unemployment. They just completed a bank acquisition of the Bank of the West in recent years, and I wonder if they have a handle on their new businesses. Otherwise, the acquisition was significant and I believe a positive. For me, most notably, the last 3 quarters have had increasing profits and 4 quarters of increasing interest income. It's just that they have achieved under the analyst expectations, causing the share price to take a hit. The higher loan loss provisions contributed to the lower earnings and the miss on those. The stock price to earnings ratio is 12.8, which is lower than most of the other Canadian big banks. They also are the only Big 5 Canadian bank that is near their 52-week low and has been trending downwards. Even Toronto Dominion, with its scandal, is trending upwards. So as a value investor, I see an opportunity to get BMO cheaply here. Canadian banks tend to take turns being at the top and being the cheapest. BNS has had problems for years and seems to be making a positive move. So now it is BMO's turn to be at this bottom of the pile. So now is the time to buy them. Note that they can certainly go lower. With a PE at almost 13, the price can fall so the PE is in single digits, where I would prefer to buy them. But BMO may never get to single digit PE, so there is a belief in the organization. I certainly don't see them as being a value trap. They are somewhat cheap for a reason, but will recover. If you are a nervous investor, wait and see if the PE gets into single digits and buy then, or buy your position in quarters or fifths if the price keeps going down. I also like BMO's 5.5% dividend yield, which is being increased at 11% per year over the last 5 years and is rock solid. BMO is a stalwart, well-capitalized, strong Canadian bank that has had some perceived, some real difficulties and is an opportunity at this price level, especially when you have a long-term outlook. It has missed estimates in 2 quarters and may miss the next few, but will ultimately do well since all the concerns are already priced in. If you have any requests on what you would like me to cover in future videos, please put that in the comment section. If you'd like to get in touch, please reach out on any of these social media channels, and may you have a profitable day.